Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about backtesting. Backtesting is something that I personally believe is a crucial aspect to becoming a better trader, so we'll talk about exactly what it is, as well as how you can do it if after this video you decide that backtesting is something that you want to include in your trading journey as well. And if you don't know, here at Earn to Trade, we do offer a very awesome opportunity for traders that have the skills, but not the funding, to achieve their trading dreams. We have a test here at Earn to Trade that if you pass in as little as 15 traded days, you can become a funded professional trader trading with someone else's money, yet reaping rewards from it. It's very cool. I recommend checking it out if that sounds like something that you feel you are good enough to pass. The link is down below or up above, so make sure you check it out. But let's get back on into that material and talk about some backtesting. Many traders will tell you that trading without proper backtesting is akin to playing in a casino. You might win a couple of times, but you'll generally suffer significant losses in the long term, and the reason behind that is quite simple. We are trading without having any logical data behind what we're doing to support us, to give us an idea of some expected results as we go forward. So what is backtesting by the definition? Backtesting is a method of analyzing your current trading strategy's performance during a time frame in the past. Keyword, in the past. Backtesting is a trading strategy method that allows us to use that past data to employ our strategy upon, which means that we can theoretically trade without any risk because we're not actually trading. We're seeing how our strategy would have performed in the past without using live market data in a live account and risking and paying the learning tax, as it is so called. Backtesting generally aims to help generate results and evaluate the risk and profitability of any particular strategy that we're looking at. And the concept is risking no capital. It's like swimming with a life vest on. We get to taste the water, we get to see how we might be able to swim, but it'll keep us from sinking because we're not actually risking our capital. Backtesting for traders is really what training is to professional athletes. They spend hours refining their technique before going out and competing with the rest. And as traders, that's exactly what backtesting is supposed to be for us. We are looking to make sure that before we go and put capital at risk, we know a general idea, at the very least, of what to expect is going to happen. So, do you need to backtest? Well, you are going to be the one that needs to decide what it is that you personally need. But the two main pillars for building a trading or investment strategy are risk and return and their relationship together. Backtesting helps us quantify those two factors to show your strategy's overall profitability, as well as give you an idea of your own risk appetite. It's a good idea to backtest our trading strategy to be aware of how it will perform under real market scenarios. Backtesting allows us to simulate our trading idea using historical data and then put its risk management mechanisms to the test. And if we're backtesting a strategy, it can help us find its weak spots as well as test its resilience, and then we can even highlight where we can fine-tune it and improve it further. By doing all of this on a blackboard, we can clear out all of the issues hypothetically, strengthen our risk management tools, and gain confidence in our particular trading strategy, which can also lead to further positive results. So it's almost like a beneficial positive snowball when we include backtesting as we go forward, and we don't want to think of backtesting as something that is needed only to solve something that's not working. We can use backtesting to improve things that are already working. Essentially, backtesting gives us crucial answers to questions like, what is the best trading setup for our particular needs and goals? Or what is the optimal risk per trade that we're willing to, expose ourselves to? Or in which market does our strategy work best? We can also find out if our entry and exit triggers are well adjusted, or adjust them as needed and then take that live. Another fundamental reason why backtesting is so sought after by traders is that markets today are run by data. Historical data, forward-looking indicators, predictive analysis models can be more valuable because of this simple fact. By backtesting our trading strategy, we can find out how it would have performed in the past and get ourselves an idea if going forward, if parameters stay the same, if it'll be successful potentially in the future. Let's talk about the things that we need before backtesting. The most important thing is to try to find unbiased data to avoid skewing our model's performance. If we use biased data, it will almost inevitably skew the results of the test, therefore making the test less valuable if not completely useless. Although completely staying away from biases isn't really possible, we want to make sure that we mitigate their effect as much as we possibly can. There are several types of biases that can affect our data, and consequently it will affect our model's performance. The first is the optimization bias. This is also known as curve fitting. It describes situations where traders introduce additional parameters and win trades until their strategy's performance satisfies their expectations. Alternatively, covering the cracks, as some traders say, of the system will artificially inflate the results, and that's not good. The only thing that we'll achieve by doing this is lead to unexpectedly poor performance when we finally go live. Then there's also the look-ahead bias, where we can accidentally include future dates in the simulation that we're running. This error can happen due to improper parameter calculations, a technical bug, or various other reasons. We always want to make sure that we're not including that future date information when we are backtesting. There's also other types of biases, and another one is called the survivorship bias, and this is a bias that develops when backtesting strategies on datasets that fail to represent the full range of relevant assets that we're interested in trading. Another one still is the psychological tolerance bias that occurs when backtesting on long-term periods to improve the performance, but in reality we plan to trade on short-term periods. After we make sure that our data and our backtesting methodology are bias-free, or at least as much as we can, it's generally time to focus on choosing a backtesting software. If we are trading through a particular broker, the chances that they usually have some type of built-in backtesting feature or some way to use their software to backtest to some degree. The benefit is usually when you have a software that allows you to play the charts back in real time, and not all of them offer that. That's a little bit more difficult to find, but it can be done with your own eyes as you scroll the charts to the left as well, instead of just simply needing it to play out like it's a real-time scenario in the past. There are also ready-made platforms that you can find or subscribe to that will allow you to specifically backtest on their platforms and offer neat features that make backtesting a little bit more intuitive. But after finding the perfect backtesting software or getting ready with your current trading broker, the idea at that point is remove those biases and start getting to work. The principles of how backtesting is done is fundamentally similar no matter which platform we use. The first step is usually to feed the backtesting algorithm with the carefully sourced historical data. When testing a trading strategy on historical data, we need to specify a concrete period for our trading data set. This could be, for example, say 2020 to 2021 if we want a year span. Then we need another set of data for an alternative period. The reason for testing a strategy over different periods is to validate its reliability and mitigate the role of randomness or variability that can happen in the entire process. Next, we want to go ahead and make sure that we have set up some parameters depending on how complicated your particular backtesting model is. This might include things like initial capital or capital risk percentage, portfolio size, commission fees, the average bid-ask spread, and even things like a benchmark like the S&P 500 to use to make sure that you're actually outperforming something that is an easier option. Then we have number 3, where run the backtest over your testing data sets is going to be exactly what we want to do. We want to take all of the information above that we talked about and then go ahead and simulate those trades over that time period. After we conclude our backtest, the next thing to do is to rerun the process at least a couple of times over on another set of data to continue to cut off any potential biases that might be left or lingering in this process, even if it was unintentional. We want to remove that random factor as much as we absolutely can. After we finish backtesting, it's time to interpret the results and see how our strategy has performed over the observed period. And we should be aware that there's no golden formula or single rule that will define whether our trading strategy is simply good or bad. For all of the analysis that we do, we need to keep in mind the necessary context. Some of that context could include things like the other assets that we have in our portfolio, or the market environment, or the strategy's unique characteristics. Some strategies, for example, are riskier just simply by design, and naturally they will achieve higher profits as well when they are performing well, whereas others might be more conservative and will lead to lower increases but could be a more reliable option for the long term. The best way to evaluate our trading strategy's results is simply by defining our risk appetite and profit goal and making sure that it's in line with those. After we run the backtest, we'll check whether the strategy generates results that are in line with us. Also, we want to make sure to add a benchmark to our results, which we could do with something like, for example, the S&P 500, because that is the most widely one that traders use. After we execute the backtest, we can see how our strategy is comparing against a common benchmark. The backtesting methodology will generate results for different measures, including net profit and loss, total portfolio return over a given time frame, risk-adjusted return, market exposure, volatility. All of these things are things that we want to gain access to throughout this backtesting process. And in the end, the idea is that we want to quantify the results of the backtest for each of these measurements. Then we can decide if it's in line with our particular ideals and if it is outperforming an easier accessible benchmark. We don't want to make the mistake of choosing our strategy solely based on its returns directly. Although profits are essential, when out of context, they don't provide any real useful information. Just the opposite, actually. They can deceive us and make us choose a highly risky strategy, which very commonly is something that happens to new traders. To avoid falling for that trap, we want to analyze our returns in addition to the adopted risk. Understandably, the best strategies achieve satisfying returns without significant exposure. That's the best of both worlds. If we're finding a way to get reasonable returns and we're keeping our risk at a minimum, I don't know anybody that would be unhappy with that. We also want to make sure that when we're backtesting that we're tracking volatility. If after the backtest we spot that our portfolio has periods with specifically high volatility or abnormally high volatility in relation to the rest, we should be aware that this can translate into real-world trading, and this is something that could happen when we're executing or have our strategy running live, which could trigger things like stop losses or take profit orders prematurely or what have you. So be aware of the moments where our strategy has these excessive periods of volatility. Another essential thing that will help define our success is by paying attention to the correlating assets. If our asset is entirely too correlated to other things that we are already trading, we aren't really feeling overly diversified in this scenario, because if we have a good day, the good day is going to be great, but when we have a bad day, the bad day is going to be awful. So in a lot of ways, it's helpful to have a few different things that correlate oppositely that we run our strategy on. It wasn't that long ago that backtesting wasn't really something available or easily possible for the retail trader. It would be silly at this point in our lives to not take advantage of all of the cool tools and opportunities that we have to make sure that we're fully prepared before we go into the proverbial battle. Backtesting is a crucial part of what has allowed me to become a trader myself, and I strongly encourage that those of you out there that are trying to find your way in the trading world continuously backtest and make sure that you keep your risk as low as absolutely possible until you can justifiably prove that it's time to rock and roll. And when it is, I'll see you at the Gauntlet Mini. Until next time, folks, over and out.